If we take a look at that risk sentiment, are we in a situation where this is a buyable dip, in your opinion?
Wow, that's a good question. Thanks for having us this morning. Like you mentioned before, markets are very much in a trading range here between 2,600, 2,800 on the S&P. I think the markets are still looking for a bottom. So we see the short-term view as very trendless right now. So to suggest it's a tradable bottom here, you can trade it on a short-term basis within that range. But quite frankly, we think that there still may be more downside to go, at least over the short run. We haven't seen real signs of capitulation in the markets. We've had a few sort of heavy bleeding days, some 90% downside days where the majority of sectors and stocks are participating in the sell-off, but you haven't seen that real flush. Our guess here is that over the short run, maybe within the next few weeks or so, maybe even into the new year, the S&P 500 could break 2,600 one more time, give us a real sort of panicky type of day on heavy volume, heavy selling, and then we can start to see signs of a bigger bottom in the markets for 2019. Beyond this correction period, we're still very bullish on the markets. However, if you look at the history of any bull market, you go through these correction periods oftentimes. And the correction period is a cycle. It's a process that can take several weeks, if not months. You could have multiple tests of the lows. You could break to new lows. But the bottom line is you want to flush out those sellers. You want to exhaust those sellers. I'm not entirely convinced we've seen that yet. So we continue to view choppy markets over the short run. There's going to be really violent swings in both directions. But I do think you could either see a test or a break of that 2,600 level before this is said and done.
All right, Dan, so as we talk about the choppiness that you just referred to, one of the things that we looked at yesterday was the leadership of the market going to record highs. And those stocks are among the choppiest out there at these levels, indicating there's a battle developing whether or not people want to buy beaten down shares of companies like Alphabet or Apple or Netflix or some of those other big technology or communication services oriented names. Are those names that you would be looking to add to a shopping list if there is a resumption of that uptrend?
Yeah, so that's a great point. You know, typically in correction cycles, big correction cycles in bull markets, you can see a shift in sector leadership. So to your point, you know, broad tech, FANG, that's been an outright leader in a significant way for, you know, certainly the last year, maybe 1 or 2 years, if not longer. I think we're starting to see a little bit of a shift in leadership. One interesting development throughout this correction process has been the outperformance of healthcare. But not just healthcare defensively in down days. On our rally days as well, we're seeing healthcare outperform the markets as well. And one of the things we did was we created or built a ratio of healthcare divided by technology to see the relative strength between those two sectors. And healthcare, for the first time in several quarters, is really starting to turn the corner relative to technology. So our theory here is that as we move through this correction process, investors may be rethinking their overweight in technology and really starting to broaden out or diversify that concentrated position that they had in tech and moving it out into broader healthcare. Now, broader healthcare is diversified in itself. You have defensive groups within healthcare, and then you have really pro-growth, pro-cyclical groups. So our guess is that once the bull market resumes, we get past this correction process, the market finds a bottom, and we see that upturn on a significant level, you're going to start to see more of the pro-cyclical, pro-growthy areas in healthcare really start to lead. That could be biotechnology, life sciences, bioproduction, things of that nature.
Dan, just a few moments left here. We have made note of market sentiment a lot over the past couple of months, given the record highs and the drop there from there down to where we are now. As we take a look at market sentiment, in your opinion, are we in a situation where we can say that we went from an accentuate the positive type market to an accentuate the negative type market? And if so, what do you need to see to change that?
Yeah, absolutely. That's a great point. Sentiment, in my opinion, has skewed very bearish very quickly. And what's interesting is, to that point, the markets aren't really expensive here. In fact, in my opinion, the market multiple is rather cheap. I think the trailing 12 now in the S&P 500, if I'm not mistaken, is somewhere around 16, 17 times. historically that really has an indicated peak multiple in terms of secular bull cycles. So the fact that sentiment has shifted or skewed to the bearish side so quickly against a decent multiple, I mean, I tend to think this will eventually, within a couple of months or so, prove to be a great buying opportunity. Now, what's going to shift that sentiment? The market. I mean, the market is a leading indicator and a discounting mechanism of sentiment. So I don't know that any binary event may necessarily shift investor sentiment from bearish to bullish. But once the market finds its bottom and breaks out above that 2,800 zone onto new all-time highs, which we think it does in the years ahead, you're going to eventually see investor sentiment shift back from the bearish position it's in today back to very bullish.